everybody. 8 p.m. Eastern, Wednesday. It means it is Taxes and Retirement Live. Thank you for joining. I am Andy Panko, host of Taxes and Retirement Live, owner of Tenant Financial. Special monthly mailbag. Where are we at? Mailbag edition tonight. For those of you who are new here, which there are a lot of you, there were 700 plus people join over the last week. So welcome everyone. Large part of you were from the Boomer Benefits group, and a decent chunk were also from the Roger Whitney podcast. So welcome everyone. But for those of you who don't know, this is a weekly live video that I do. Once a month, I do this mailbag where it's just a free for all of your questions. So you feel free to post questions in the comment in the comment section to this post that you're looking at now. The other episodes throughout the month are about a specific topic where I either have a special guest on or talk about something else in detail. So anyway, thank you again for joining. Quick updates, make sure comments are working here. Yes, they are. Hello, howdy, David Fultz. So David Fultz, I know you asked last week. I forgot to mention it. Weight loss update. Again, for those of you who are new, this is the 6th week I've been attesting to you all my weight each week as I'm trying to slowly and steadily lose a pound to a pound and a half a week. Over the last 2 weeks, I'm down a pound in total. So I'm 168.5 now. Which is good. It's where I want to be. So for 6 weeks so far, I'm down 7.5. Is that right? 7.5. So a little over a pound a week, which is good. This next week probably won't be great. I had a wisdom tooth out on Friday, so I have not been doing any exercise. I don't want to pop it and get dry socket, whatever it's called. I hear that's not cool, but I should be able to get back at it in the next couple of days. And I will be away the Rock Retirement Club's rodeo in Fort Worth. So I'm sure there'll be some drinking, possibly some BBQ, definitely no exercise while I'm there. So who knows what my weight reading is going to be on Monday, but I will be enjoying myself. So at least there's that. What else? I did get 3 questions for today, one of which was just a couple minutes ago. So I haven't really looked at it in detail. Hopefully I could come up with something respectable to say for it in response. And just before we go, I got this dad joke thing. Yeah, Mark Troutman. So Mark is a steadfast member of the Rock Retirement Club and will be there in Fort Worth on Saturday. So yeah, Mark, I'm looking forward to seeing you. I've met you on Zoom a handful of times, but it will be cool to see you in person. So yippee-ki-yay, or whatever they say at rodeos. Dad jokes for the evening. Again, for those of you who are new, I got this shtick that I do where I kick off each week with 3 different dad jokes. So first, I was in a job interview yesterday, and the interviewer asked if I can perform under pressure. I said no, but I can perform Bohemian Rhapsody. Get it? Queen. Oh, man, they're both Queen songs. A policeman spotted a lady driving while knitting. Pull over, he said. No, it's a scarf, she replied. Come on, cop, get it right. And finally, where are we? Give me a second here. Finally, I asked my wife when her birthday was. She said March 1st. So I walked around the room and asked her again. Hold on, wait for it. Yep, March 1st. March beforehand. All right, before we go, one final bit of housekeeping here, if I can find it. This video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. I'm just some guy, unshaven, with a freshly pulled wisdom tooth, who is answering random questions for you all, hopefully telling you accurate information. I've said this before, I say it again. These responses and information is accurate and correct to the best of my knowledge and abilities. I cannot guarantee or attest that this is all actually accurate. So definitely fact check me, spot check me, run this by your actual legal, tax, investment, insurance advisor, whatever. Because again, I'm not that. I'm just some random guy here trying to answer questions I think I know the answers to. And if I don't, I'll tell you. But this is Facebook. This is free. Confirm all these things before you actually attempt to act on any of it. Because again, I do not give any specific advice to any of y'all in this lovely group. Okay. So the way I'll do it, I got these 3 questions. I will answer these. And then for the rest of you, as I mentioned, feel free just to throw questions in here. Typically, the rest of you astute people will respond to comments and questions while I'm sitting here rambling. But for tonight, for these mailbags, please don't do that, because the streaming software I have, I can't see who responds to what. All I see is every single comment, whether it's a response to someone else's or a fresh comment, it all shows up the same. So it's hard for me to parse through and figure out what are actual questions and what's just like someone else having a sidebar conversation. So if someone does ask, a question directed towards me, please don't take it upon yourself to respond to it. Not because I'm trying to hog the microphone, just to help me, organize and make sure I get to people's questions. So first question from Brenda Pulvey in Wisconsin. Brenda's question is, my husband and I have a joint stock account, joint brokerage account, let's call it. It's technically company stock, but it doesn't matter. So they have a joint brokerage account. They're retired. Husband is 6 years older. Would it be a good idea to retitle this account in his name only as opposed to joint? I'm thinking future step up in cost basis. Am I missing anything? ? So few thoughts. So what Brenda is getting at is, in the vast majority of states, when spouses own something, you commonly own it as like joint tenants with rights of survivorship. So what that means is each spouse has a 50-50 interest in whatever's in that account. When one spouse dies, the other one automatically receives ownership of the rest of it. That's that with rights of survivorship thing in the title. And that works really well because it automatically transfers. It doesn't have to go through the probate process for the local court, a probate judge to decide who gets it. It doesn't go through your will to figure out who gets it. It just simply, upon one spouse passing, the other spouse gets it. Done. Pretty clean. In most states, there's what's called the step up in basis in most states is as followed. So any joint account, like joint tenants or rights of survivorship, like I said, is assumed to be owned 50-50 between the spouses. So let's assume you get married, you open up a joint brokerage account, and you and your spouse collectively buy a stock for $100. You own it for 30 years, it goes up to $1,000, let's say. You each own half of that. So it's as if you each paid $50, because again, the original cost was 100. You each in effect paid 50 is how it's viewed. So you each have a basis in your half of $50, cost in your half of $50, and the current market value of $1,000. You each own half of that, so you each own $500 at current market value. So each of your halves is currently worth $500 with $450 of gain, because again, your half of the original cost is 50 and your half of the current value is 500. So you have a 450 gain. When one spouse passes, that spouse's portion gets stepped up, meaning whatever the current value is, or whatever the value is on that spouse's date of death, the other spouse inherits that half at that date of death value. I wish I had a little number thing. I'm talking about a lot of numbers. It'd be easier to write this down to show you all. But the point is, as a surviving spouse, your half still has an original cost of 50. The half you just inherited from your spouse now has a cost of 500 because that half was stepped up. So when you own the total position now, total value of $1,000, and your cost now is 550. Because again, 500 from your spouse's stepped up cost and 50 from your original cost. So if you were to sell that $1,000 stock today, you would have a gain of $450. Now, if it's not a joint asset, if one spouse owned it outright, his or herself, when that spouse died, the other spouse would get ownership, assuming that's what the will says, and the probate court actually, probate judge agrees with the will and does indeed transfer you these assets. You would get a full step up in basis. So the full $1,000 position would now you would get that position as if you bought it for $1,000. So all that gain that was in your deceased spouse's hands goes away. You inherit it as if your cost was $1,000. That's the upside. So yes, Brenda, in theory, that works. A few caveats, and I won't, not least of which is you live in Wisconsin, which is a special situation. But a few caveats. If this came up on last month or 2 months ago, Mailbag, if one spouse does do this transferring to another spouse, so if you have a joint account, you swing it over to just one spouse's name. If that spouse dies within 12 months, you can't get to step up in basis because there is a rule that the IRS tries to prevent people taking advantage of. So perfect example is you're married, God forbid your spouse becomes terminally ill, and it's clear he or she's not going to live, more than a couple months. So you may think, hey, wait, let me at least game the tax here. We currently own a joint. Let me give it all. Let me retitle it to just my spouse. That spouse dies 3 months later. I now inherit it all, get fully stepped up in basis. Sounds great. Not going to work. The IRS is one step ahead of you. Again, there needs to be 12 months have to pass from the time you do the retitling to when that spouse passes. If the spouse passes within 12 months, this plan gets shot down and you don't get any of that beneficial step up. It's as if you two still owned it jointly, in effect. So you have to keep that in mind. The other downside is it will now have to go through probate. If your spouse owns it solely and you're no longer a joint owner, you'll still ultimately get it, almost certainly, assuming that's what your will says. But nonetheless, it will have to go through the probate court process. It's going to have to go through your will. The probate judge is going to look, and he or she could potentially disagree with your will and say, no, I don't think the spouse should get it. Chances of that are small, but it's possible. So you have that. So there's more time and process and potentially headache involved with you eventually getting these securities back, Brenda, but it could work. Now, what's unique about Wisconsin? Wisconsin is one of, I think, 9 community property states. Very different game here. This is more complicated than and definitely do not take this as advice. Check with your local accountant or a Wisconsin-based estate planning attorney. Because it's I don't know how Wisconsin treats it. If this is community property, so you and your husband acquired these shares while you were married, by default, I think Wisconsin will treat it as community property, even if your account isn't explicitly titled as community property. And the nice thing about community properties, when one spouse dies, the whole thing is automatically stepped up for the surviving spouse anyway. So you won't have to go through this dog and pony show. I don't think you have to go through this dog and pony show of retitling this account from joint to just your husband, because if it is indeed community property, check with the Wisconsin attorney here. I don't know. I'm just thinking out loud. I suspect you may get full step up anyway because it's community property. So this question may be for not, thankfully, in your case, because you're in community property state, Brenda. So that's my thoughts there. Hopefully that helped. And again, definitely run this by a Wisconsin-based or someone who's strong in Wisconsin taxes and or estate planning about this whole community property thing, Brenda. Great question. Next, Joe Hickey. Long question. I'll try to sum it up. 2-part question. The gist of it is Joe has 2 homes and they owned them each for 15 years, one in Maryland, one in Pennsylvania. Why is there a dinging going on in my ears? I don't know if you all can hear that or not. But anyway, the Maryland home was their primary residence for better part of 20 years, from 2001 to 2019. 2 years ago, let's call it November 2019. In November 2019, they switched. They made the Pennsylvania house their primary residence and no longer the Maryland house. They're thinking about selling the Maryland house within the next couple years. He believes the tax rule is that to receive Joe's married, to receive the $500,000 capital gain exemption on a primary residence, you must own and occupy the home as your principal residence for at least 2 years before you sell it, specifically 2 out of the last 5. So the question is, if we sell the Maryland home before next November, would we qualify for this exemption? This is another thing I wish I had a timeline or a little screen here to put up. So again, owned a Maryland home and Pennsylvania home for 15 plus years. Lived in the Maryland home from 2001 to November 2019. Then moved into the Pennsylvania home and has been living there since. So meets the 2 years for the Pennsylvania home, but that's not his question. The 2 years is, if we sell the Maryland home within a year, will I be able to exclude $500,000 of gain on the sale of the Maryland home? I have a couple thoughts. So first, you didn't say what I didn't think to ask you this until I read it again tonight, but you didn't say whether this was used as rental property or just vacation property. So let's assume it was just a vacation property, just a second home. The answer is yes. If you do sell this Maryland property by November 2022, then you will have met the condition that you lived in and owned the Maryland property for at least 2 out of the last 5 years prior to the date of the sale, which means any gain you could exempt up to $500,000 of gain on the sale of that Maryland property. That also assumes you didn't also use this gain exclusion in the last 2 years on any other properties. But I'll assume you didn't. So yes, that would work. Not a problem there. What's this next question? If you do not sell the Maryland home before November, can you then make it your primary residence again? So that would still be your primary residence. Yeah, long story short, sure. You can move back into it. The 2 out of the last 5 years thing, it doesn't need to be 2 consecutive years. It's I think that the technical wording is 24 months. Maybe you can even count days. I don't know. But you can piecemeal together 2 out of the last 5 years. And sure, that would work. Take it a step further. This isn't what you asked, but yeah. So let's assume you sell the Maryland property within the next year. You can get your $500,000 gain exemption on that. If you wait 2 years, at least 2 years, you can then sell the Pennsylvania property if you wanted to, assuming you lived and owned in that for 2 years. You can then sell that and also get, again, up to $500,000 of gain exemption on that. I'll assume it's not a rental just because that complicates things. And I did go over this in more detail a couple weeks ago when we talked about rentals. Maybe it's 3 weeks ago, but go back and check that video for more. That gets complicated because you have this depreciation recapture you'd have to take. You can't get that excluded, but otherwise in this scenario, you would still be able to exclude the capital gain on the Maryland home, but you cannot exclude the depreciation recapture you'd have. I'll leave that there. Your final question on this chain was basically, if you do have to pay tax on it, is it long-term capital gains? Yes, the answer is yes. If you held it more than a year, which you did, you held this thing for 20 years, any gain you do have would be long-term capital gain. Again, that depreciation recapture, if this was a rental, that would be a different animal. That's taxed at your ordinary income rate up to 25%. But if this was just a vacation home, yes, any gain you do have would be taxed as long-term capital gain. Hopefully that answered the question, Joe. Thank you. And finally, give me a second here. Let me hydrate my my wisdom tooth. Or I should say my wisdom tooth void. Surprised how barbaric removing a wisdom tooth still is. I don't know what I was expecting. I had a wisdom teeth out 20 years ago, and I was out. I had general anesthesia for it. This time I thought I was cool. I was like, let me just get the Novocaine. The doctor said it wouldn't be that big of an extraction. It wasn't enjoyable. I wish I was out. But point it, there's just a lot of brute force. I'm surprised. I don't know what I expected, but I would have thought this day and age that there could have been like a more finessed way to get a tooth out of someone's skull. Apparently not. Okay, so final question, final pre-sent question, just got right before we went live. Kelly Hahn. The question is, if you have a separation in service from federal employment after 27 years, can you draw a pension at 60? Because it's been there over 20 years. So I'll pause there for now. I don't know. I didn't have time to look this up. I don't know off the top of my head the rules again around federal pension. So this would be the FERS pension. I do my math right. 27 years. Yeah, I think that'd be FERS. I don't know if you need 30 years or 25 or what. I don't recall what it was. So honestly, I don't know the first part of that question. If anyone watching knows about federal pensions and whether or not she qualifies. So just to recap, 27 years of service, she'll be 60. Can she draw on her FERS pension? I think the answer is yes, or maybe at reduction, but I really don't know. I'd have to look that up. Sorry. The next part is you also have the thrift savings plan, so the federal equivalent of the 401k. With a sizable balance, you have some Roth money. Okay, what's the best way to live off investments and tax strategy until 60? So, I'm sorry, I guess it wasn't a question, it was a statement saying you can draw your pension at 60 because you have over 20 years. So, in the rest of this is saying you have a TSP with some Roth. What's the best way to live off that until 60? And I guess that until 60 is when your pension starts. Got it. This is making more sense now. Without knowing the rest of your details, I really can't say. Without knowing your expenses, other possible sources of income, marital status, the rest of your tax situation, I really can't say. It also depends how old you are now. So like if you're only 50, you can't touch your TSP anyway without penalty, which will be a wrinkle in things. But generally speaking, the approach to do this tax efficiently is, if you have discretion and you have your money in different pots, which you do to some extent, most of it seems like it's traditional pre-tax, but you have some Roth and it looks like some regular investment accounts. You'd have to kind of massage your tax brackets and sources of income each year while paying attention to how much dividend income, interest income you may have, other sources of income, perhaps a spouse who has money, has wages, I don't know. And just figure out the combination of account withdrawals that is used most tax efficiently. So like if you're married, for example, you can have $105,000 of gross income and still only be at the top of the 12% tax bracket. If you're single, that number is close to $55,000. So like hypothetically, if you can access your TSP penalty free, without the 10% early withdrawal penalty, then maybe you pull out 50-ish grand from your tax deferred TSP to fill up your 12% tax bracket, depending how much of your necessary expenses that covers and how much more money you need. Then maybe you tap a little bit of your investment account, but then you have to see, are you selling things at gains or losses? So that factors into the taxability of it. Maybe you tap your Roth a little bit. If you have a home, maybe you use home equity instead. You use that as a bit of a bridge, or at least partially use home equity instead of just going full bore into tapping your TSPs and savings accounts. It also depends how much of your expenses will his pension cover. If when you do turn 60, your pension is going to cover everything, plus you have Social Security at some point, then you don't need to be as concerned about spending down your TSP as fast. But if your pension and or Social Security won't come close to covering your expenses, you got to be a little more delicate with how much of your TSP you eat into between now and then. So, sorry, not a great answer, but this is really, seemingly simple question on the surface, but devil's in the details. There's way too many what ifs and variables that will come into play. It may be best to reach out to a financial planner who does hourly work or one-time financial plans. Have him or her go through all your details and get clarity about the things I'm just sort of spitting out as things to be considered, and actually help you map out, is this doable? And if so, what's the best way to do it? I don't do things like that, but you can go to places like the Garrett Planning Network, is a network of fee-only advisors who all offer services on an hourly or sort of one-time basis, limited scope basis. Someone there, you can probably find someone there to help you put together a plan without having to commit to work ongoing, because you don't necessarily need that. You may just need a once over to get all your ducks in a row and help you plot a course for the next handful of years. All right, hopefully that answered it as best as could be answered. Kelly, thank you for the question. All right, that was it for the pre-shared questions. Let me just go to the top here, see what else we got. iBonds. I have several iBonds that are payable on death to my sons. If I die before the iBonds mature, do my sons have to cash in the iBonds at that time, or can they wait until the iBonds mature? That's a good one. I don't know. This may have come up a handful of months ago. Dave Myers, if you're here, I think you may have been the one to respond to this. So feel free to chime in. Not to put you on the spot, but chime in, Dave. If you're not here, don't worry about it. I don't know. I frankly, I have no idea functionally how this works. I don't know if iBonds are such that once the original owner dies, like they have to be cashed out. If that's the case, you have an option. Or maybe they're like any other asset. They'll continue to live on in the heir's hands until their stated maturity, at which point, they would then stop like they would have stopped in your hands. I really don't know. It's a great question. Hopefully someone else knows the answer to that. Cody Garrett making references to the rodeo this weekend. See, I don't even know what tie-down roper means. Cody's from Texas. He wears big hats. He's got shoes with spurs on it. He knows what tie-down roper means. I always, not always, but I occasionally say when I'm doing something that I haven't done for the first time, I'll be like, yeah, this isn't my first rodeo. I'm sure you've all heard that. This will actually be my first rodeo, literally. So I cannot say this isn't my first rodeo, because it is. Mark Trotman, when are the new 2022 tax brackets typically announced? Yeah, I don't remember. It's a good question. I know last year, as soon as they came out, I did a recap of them. I want to say some point in November. I can be completely wrong. I'd have to look. I mean, it's before next year. I know that much. I think November at some point, but I really don't know. I will. You can even go back in the group. Just search for post by me with like tax bracket. Search some other tax things, and you may find it. Or if I remember, I'll try to get it after the fact and share with you the day that it was announced. Mark, what's taxable when you cash in a whole life insurance policy? So any amount of cash value above and beyond the cumulative amount of premium payments you made will be taxable. So quick example, you paid $10,000 a year for 10 years. So you paid in $100,000 in total premium into this policy. Let's assume it has a cash value of $150,000 now. So you cash this out today. The insurance company gives you $150,000 of cash. You paid in $100,000 total. You will be taxed on that $50,000 extra, and it's taxed as ordinary income. Here's one of the the not so great things about cashing these out. It's not a long-term capital gain. There's no preferential tax treatment to that gain. You get a $50,000 ordinary income payment to you in that year. Now, if the cash value is less than your cumulative premium payments into it, then there's no tax event. I mean, you paid in $100,000, you only walk away with 80. There's no tax because you're walking away with less than what you put in. Good question. Can you share your wisdom tooth about protection of government 457B plans for my creditors as well as my employer's creditors? Ooh, saucy. I don't know. With 401ks, at least, they're covered by broad federal retirement protection regulations called ERISA, Employee Retirement Income Security Act of 1974, I believe it was. Those do provide complete bankruptcy and creditor protection such that the monies in your 401k I know it's not what you're asking 457, but I'll tell you where I'm going with this. Plans that are covered by ERISA have complete creditor and bankruptcy protection. Can't be touched. Cody Garrett shared with me at one point apparently this was O.J. Simpson's case. It was called I forget the term that he used for it, but basically, even though O.J. knifed his wife and his wife's boyfriend, they were not able to sue him or get after his 401k because it was under ERISA, completely protected, even under murder. Who would have thunk it? That's how strong these protections are. So in 401ks, they're completely protected against your employer's creditors as well, because it's not the employer's assets. It's off to the side. It's its own bankruptcy remote, independent of the employer. 457s, I don't know. I don't believe they're covered by ERISA. I'm pretty sure they're not, because ERISA specifically covers private pensions, like non-municipalities, non-governmental pensions. 457 by definition is a it's a public employer plan, like municipalities typically. So my hunch is it may not be protected. It may, I'm just making this up, I really don't know, but it may be at the risk of your employer's creditworthiness. So let's assume your 457 is from you're an employee of a local police department or something. So you work for the state or for the town or whatever it may be. I think your plan may be at risk of, if your town or state goes belly up, your plan may be hurt. But I really don't know. I'm just thinking out loud. If anyone else knows, feel free to chime in. Because I don't. Great question. I don't know why I haven't come across this before, but thank you for whoever asked this. Would you comment on how financial planning is both an art and a science, and how optimizing for one area may lead to sacrifices in another? Yes, great observation and question, David Fultz. 100% right. All this stuff is an art and a science. It's a science in that obviously we're working with numbers and facts and figures, but it's an art for a few reasons, because we have to make lots of projections. Especially, in retirement, you just retired, you're 60, you can still feasibly live for 40 years. So you have to try to project, your expenses, which are impacted by, amongst other things, inflation, which nobody knows, your own life circumstances, when you're going to live, how healthy you'll be, what you'll be doing, what your interests and hobbies are 5, 10, 20, 30 years from now. We don't know, but we got to try to guess. What the financial markets are going to do, stock markets, bond markets, we don't know, but we got to try to make a guess. What tax legislation is going to do, we don't know. I suspect it'll go up, but we don't know. We have to make a guess. Realizing there's so much educated guessing in here, it is literally impossible to make a plan that will prove to be accurate. The plan will be wrong. It will be outdated. It will need to change along the way. Even in retirement, all this stuff is a moving target, for better or worse. But you want to keep making sure all your different analyses and projections and what ifs, if they all look good now, again, don't worry about the actual trying to pinpoint a precise quantifiable answer as to, how much exactly I need to retire. You're looking for ballparks and stuff. But if all these analyses point to, yeah, this plan works, you want to keep updating and re-upping these analyses every year and look for trends. If you start trending away because your expenses start running away, or we have, God forbid, like in Japan, where its stock market hit a peak in the late 80s, crashed, and still 30 plus years later is not back to the levels it was in 1989. This is why you do not invest only in the United States or only in any one country for that matter. I like to think what happened to Japan can't happen to the US, but who knows? It's possible. So, diversify. Don't put all your eggs in one basket, whether that basket is one company or one country or one sector. Diversify. So anyway, so that's the art. Lots of sort of voodoo and projections and educated guesses and things that are statistically reasonable and possible. That's what we're basing it on, but there still is a lot of sort of guessing and intuition. The other part of the art is, I'm stealing this comment from Rick Edelman, personal finance is more personal than it is finance. 100% true. The finance stuff is important, but so is living the life you want to live. Waking up and going to bed happy is what life is all about. Money is not the goal. Money is a tool to get you to your goal. The goal should be doing the things you want to do with the people you want to do, hopefully getting some fulfillment and satisfaction and enjoyment and a sense of purpose in your life. That's the goal. Money is not the goal. For some people it is. And, maybe that's right for them. But generally speaking, money is not the goal in life. Money is just a tool to get you to the goal. So that's the other part of the art. Everyone's answer and views towards things is going to be subjective. It's going to be different for them, how much they want to leave to heirs versus not. Some people can't sleep unless they have at least $1 million in the bank, and other people are like, fine, whatever, let it ride. So that's the art. Great comment. I mean, there's lots of ways I can go with this, but I'll stop there because I'll just keep rambling otherwise. But thank you, Dave Fultz, for that. Ooh, K1. An investment of mine is habitually late sending a K1. You are not alone. I hate partnerships and things that have K1s because they are more times than not late, and that monkeys up the tax return filing. I usually file an extension until I get it. Any issue with filing without it in April, then amending later instead of the extension? Not having a filed tax return this year until last week delayed a loan application, so I don't want that to happen again. Great question. Let me think about this. I don't think so. I could be missing something. Yeah. I'm just thinking out loud. I mean, maybe if you file your return by a typical April 15th deadline, you pay your tax, whatever it is, then you get your K1 a month later, and that K1 shows you had an additional, 50 grand of income that you did not account for, and you now amend. I don't know if they would penalize you for that being late. They'd probably penalize you anyway, even if you extended. I really don't know. This is a good question. My initial response is I don't know that it would matter. I don't know if it's more work for you or more expense, depending who does your taxes, what their fees are for an amendment versus an extension. An amendment may be more expensive. I don't know. So keep that in mind as well. But I definitely appreciate needing the return in hand because it impacts something else, like getting a loan. If that's the case, and yeah, maybe get your return done. I really don't know. Don't take this as advice. That's an interesting question. I would think you should be able to do it without much harm, but I really don't know. There may be some angle I'm missing here. That's a good one. Thanks for that. Sorry, I had a terrible answer. When did Roth 401k become legal? Can I treat the after-tax contributions to the employer's retirement plan many years ago as a Roth, even though it is not named Roth? Depends. So I don't know. So Roth IRA started, I want to say it was 98. Definitely in the 90s. I think it was 98. I could be wrong. Maybe it's a few years earlier. Roth 401ks, I don't know when the first one was. At one extreme, they were possibly started as early as Roth IRAs were started, which would have been late 90s or mid 90s. I don't know if it was separate 401k regulation that was needed to expressly make Roths okay and 401ks. If there was, I don't know when that happened. Let's just assume it was 20 years ago, just to pick a number. You made after-tax contributions a while ago, not to Roth, but to regular after-tax within your regular 401k. Can you change that to Roth 401k now? So if your plan allows what's called in-plan conversions, then sure, maybe you can. You can take those after-tax contributions. Let's assume it's $50,000, making up a number. Convert just that $50,000 over to your Roth account. There shouldn't be any taxes due because you're converting money that wasn't taxed. Now that money's sitting in your Roth 401k. All growth from that point forward will be tax-free Roth growth, which is awesome. So yes, if you can do it, definitely it's probably worth doing, but you have to ask your plan administrator if it's allowed. A lot of plans don't allow in-plan conversions. Now, if you can't, what you can do is if and when you eventually retire, quit, get laid off, whatever, you can then, after the fact, roll your 401k into an IRA and Roth IRA. In that process, you can peel off that after-tax money. Then you can definitely roll that after-tax into a Roth IRA. There will be no tax upon that process. And the rest of your money's in your 401k, you peel off and roll into a traditional IRA. There will be no tax in that process either because that money's staying within the tax-deferred world. So that you can definitely do, but that requires you to leave your company or get fired or retire. Check with your plan to see if you can do it while you're still working. It's going to be up to them and what they allow or don't allow. If I sell, I won't mention the specific ticker because I try to steer clear of anything that looks or smells like specific investment advice. So I'm not going to say it. But if I sell a tax-exempt bond fund for a short-term loss, do I need to make sure the previous monthly dividend is not reinvested to avoid a wash sale? Is putting these sold funds dividends into a bank account considered substantially identical? So let me think about this. So you own a bond fund, you sell it at a loss, but after the fact, you're still accruing a dividend after the fact, after the sale, you get paid out that dividend. Will that trigger a wash sale? I suppose it would. Yeah. If that dividend gets reinvested back into that same fund, yes, that would be a wash sale. Now, how would that work? A wash sale is not the end of the world. It's not like they shackle you and do the perp walk off to jail. All that happens is the loss you otherwise would have had is disallowed, and that loss gets added to the cost or the basis of your new purchase. In this case, I'm assuming the new purchase is going to be tiny because it's just a dividend reinvestment. So I really don't know how wash sale works then. Maybe only a small portion of your loss would be disallowed because the amount you rebought is going to be tiny. I don't know. I don't know if they disallow the whole sale because of this goofy little dividend reinvestment. If anyone knows, feel free to chime in. I'm not entirely sure, honestly. Worst case, they disallow the whole sale. They then add that disallowed loss to the basis or cost of this new dividend reinvestment. So now you're going to have this relatively large cost on this dividend reinvestment. It's when you eventually go to sell that reinvested dividend, that's when you'll get to realize that loss because you're going to have this big honking basis cost because it's going to have this tacked on disallowed loss from your original sale. So you're going to have a huge loss when you sell it. That's when you would recognize it at that time. So with a wash sale, you don't ultimately lose the loss completely. You just may have to defer it, which I think is what's going to happen. If you were to instead put the if you put the sold funds and dividend to a bank account, is that considered substantially identical? So selling the fund is selling the fund. There's no getting around that. If you're saying is the option to have the dividend reinvested into more of the fund or instead just paid out in cash, yes, getting that paid out in cash will not trigger a wash sale. But if that dividend's reinvested into more of that fund, that will be a wash sale. Hopefully that answered your question. I'm not sure that the last part about putting the sold fund into a bank account. Like the accounts in which this activity happens doesn't matter. It's what you do. It's if and when you buy more of that fund is what matters. And dividend reinvestment would be buying more of the fund. But whether you buy, whether you sell an account A and buy an account B, that doesn't matter. As long as you own the accounts or your spouse owns the accounts for that matter, it's all collectively considered yours and it will be treated as a wash sale. What percent of your assets do you recommend keeping in cash after retirement to use as a cushion for emergencies, market drops, and to pay taxes for RMD, conversions, etc.? You can't really think about it in percentages. This is another one of those things where the answer is going to be different for everyone in their specific circumstances. So, like, for example, there are people out there who have enough pension and Social Security that more than covers all their expenses, including their fund money. So even in retirement, they're banking, they're saving money, they're saving cash every month. In their case, they probably don't need a lot. The only cash they really need is for a planned upcoming big purchase like a car or, a big trip to Hawaii or furnace goes, they need 10 grand to replace a furnace, stuff like that. So figure out your possible expenses, over the course of the next 6 months, 1 year, whatever, and hold that much cash accordingly. So, you can't do that in percentage terms. That's more like absolute dollar terms is what you're looking at. Different story, on the other hand, if you don't have that much income and in addition to, maybe you have a relatively small pension, if any, so you're taking sizable portfolio withdrawals, then you have to look at sequence of returns, and you probably want a decent chunk, a year, 2 years. Some people go up to 3 or 4 or 5 years of anticipated portfolio withdrawals sitting in cash. So they're not at risk of any loss in the markets. So that, again, that's percentage. That's not a percentage thing. That's simply like if you're going to have to pull out 100 grand a year from your portfolio, you probably want at least 100,000 in cash sitting around, more like 200, 300 or more if you want to be really conservative. Yeah, that's my thoughts there. In terms of like paying tax on conversions, that's something you have to figure out. Like how much conversions do you plan on doing? What's the tax impact going to be? Earmark that cash accordingly. That's an upcoming cash expense like anything else, like a busted furnace, like a vacation, like buying a new car. Taxes on conversions is an expense just the same. So factor that into your total pot of cash that you want or need to hold. And again, that answer is going to be different for everyone based on their particular expense needs and other sources of income, et cetera. Another not a great answer, but this just goes to show why it is part art, part science. Like Dave Fultz mentioned, there's no dogmatic advice. I'm stealing that term from Cody Garrett, dogma. There's no dogmatic advice. It really is facts and circumstances specific for each person's individual situation. That's why the answer is almost always it depends when asking any sort of like financial retirement planning question. Thank you, Karen, for the question. Is there any way to determine year-end mutual fund estimated distributions for planning purposes? Yes. Check with the fund company and ask them. I think most companies do give some sort of estimate. I don't know what point in the year they do estimates, but regardless, definitely check with them. Or you can look at prior years. That's far from bulletproof, but to at least get a flavor or an idea for what distributions may be, you can look at prior years and just see if they've been fairly consistent in prior years. Then maybe a decent assumption to assume they'll be more or less the same now. But check with the fund company and see what they say. They'd be in the best position to tell you estimates, if any, and when they anticipate paying it out. If after-tax contributions can be converted into Roth 401k, would the converted amount be counted as part of the $19,500 max contribution? No, it would not. Not sure if one can contribute the max 401k contribution and convert after tax to the Roth in the same year. Yeah, unrelated. Again, check with your plan to see if your plan even allows in-plan conversions, but completely unrelated. The contribution is just that 19.5 is money you directly contribute out of paycheck withholdings into the traditional 401k, the Roth 401k, or the after-tax option in the traditional 401k. Separate and unrelated is conversions. That has no bearing on using up that 19.5 contribution limit. If quarterly estimated taxes are paid online accidentally, plot thickens, under spouse's social security number 1 quarter instead of primary social in a joint year, will it all get credited when filing taxes? That's a good one. I don't know. I think so. By default, you want to, whoever's social in a married joint return, whoever's social is top, that's the primary. That's always the social you should go off of when paying taxes or filing things, or and always keep it consistent. Don't flip flop year to year. Now, with that said, that's the social you should be paying taxes under. If you do happen to pay it under the other one, I still think it's fine, because those two spouses collectively are one unit in the eyes, one tax-paying unit in the eyes of the IRS. So long as it's documented which spouse paid which taxes, I'm fairly certain you're going to be fine. When you do your tax return, you'll just put down estimated taxes paid collectively by both Social Security numbers. Not 100% certain, but let's say 90% certain. I can't imagine how or why the IRS would object. Again, as long as both socials are on that return, it frankly ultimately shouldn't matter, is my suspicion. Ooh, David Myers is here. Awesome sauce. Okay, good. Yeah, I see he chimed in about iBonds. Thank you very much, David Myers. Ooh, I don't know who this is, but I like it. How are you so awesome? I don't know. No, thank you. I appreciate that very much. I don't know. I'm passionate about this stuff. And I'm an educator at heart. So that's where I come from with this. That's why I don't mind every Wednesday, 8:00 for the last year and a half, blocking out my evenings to talk to y'all great folks. You great folks. I can't use y'all, right? I'm from the Northeast. What do I know about saying y'all? I just butchered that. What's this? Can I gift mutual funds to my kids that are in my taxable account? My gum just vibrated, or my tooth was. And if I do that, can they liquidate them and pay the taxes at their lower tax rate? I realize they would. A question got cut off, but I think I know where you're going with this. Yes, you can gift mutual funds to your kids out of your taxable account. Yes, if you do that, they can liquidate them and pay taxes at their rate. However, I'm not an expert here, but there's some potential complications. Depends how old your kids are. Are your kids minor? Are they under 18? I forget where the cutoff is, but they may be subject to a kiddie tax, where if your kids have more than X amount of dollars of unearned income, they pay taxes at the parents' tax rates. And this is intentional. Here's why. Wealthy parents have minor children who have no income. They say, hey, I got this big taxable gain. Let me just give it to Junior. Junior's got $50 of income from cutting grass this year. So let Junior pay tax on it. You can't do that, but I forget the amount. Kids can only have, I want to say it's like $2,000 maybe of unearned income, give or take. Any more than that, and then this kiddie tax thing kicks in, where they start paying taxes at the parents' tax rates. So this is what you have to figure out. If your kids are minors, I don't know if minors under 18, under 21, whatever it is, but basically, if they're young kids, it depends how much the gain is. This plan may not work the way you're anticipating. You can definitely gift to them, but you got to be aware of the kiddie tax thing. There's also something called the generational. No, I don't think that would work. GST, generational skipping tax. That may only be when you skip over a generation. So that's like a grandparent giving money to a grandchild. I don't think that applies when it's a parent giving money to a child, because that's only one generation. You're not skipping over a generation. This is how much I don't know about this. I know enough to know I'd have to look it up if this ever came across my desk, with a client. But anyway, so maybe it'll work, maybe it wouldn't. Google kiddie tax and look more into that. I think that'll help answer it for you. Are there any advantages or disadvantages using a variable annuity when starting a new retirement plan with a traditional IRA and a Roth? hold on, let me digest this. Using a variable annuity when starting a new retirement plan with a traditional IRA or a Roth. Whoever this is, I'm not entirely sure what you're asking. If you can, if I can trouble you to just slap up some kind of like clarification. Do you mean taking money out of an IRA or a Roth to buy a variable annuity? Or like, are you a self-employed person and you're starting up some kind of retirement plan and want that plan to be a variable annuity? Not sure where you're going with that. So if you can clarify, I can give it a shot. Is it true that every $100,000 you convert to a Roth from a traditional IRA lowers RMDs by $3,500? Sort of. I know where you're getting this figure, and it's partially true. So under current legislation, RMDs start in the year you're 72. In that year, the amount you have to withdraw is approximately 3.9% of your account balances. So if you have $100,000 in tax-deferred accounts and you're 72, you'll need to pull out about $3,900. So this is where this person's getting 35 from. Here's another wrinkle. Starting next year, I believe it is, the RMD tables are changing to account for people's longer life expectancies. And I think that distribution percentage is now like 3.6% when you're 72. So that would mean all else equal, $100,000 means you have to pull out about $3,600, I think, in the first year of RMD. Now, that's just the first year. Every year that after, that percentage ticks up a little bit, all the way up until I think you're like 115. At that point, you need to pull out 50% of your account balances. If you lived 115, good for you. You won. Having to take RMD should be the least of your concerns. But point is, RMD percentages go up throughout time. When you're 80s, I think 80s or 90s, I think it's like 8-ish%, give or take. They keep going up. So anyway, so that's where that came from. So sure, all else equal, $100,000 less of tax-deferred balances means less RMDs. In the year you're 72, that means approximately $3,600 less of RMDs on that $100,000. But the math isn't so simple. Again, it goes up every year. So from that perspective, yes, it's true that every amount of money you get out of a traditional tax-deferred account to a Roth does reduce your RMDs by some amount. What that amount is depends on the year. So sort of true, sort of not. David Myers. There was several years after 2001 before employers were actually able to offer Roth 401ks. Okay, good to know. Beef. I get the beef with backdoor Roth, but why don't they make Roth income limits to dude? Great, dude. I don't know if you're a dude or not. I can't tell, but awesome. I know where you're going. I like where your head's at. I agree. So anyway, I guess you're referring to the pending legislation to get rid of backdoor Roth contributions after this year. For what it's worth, the more I read, the more I don't think this is going anywhere. I mean, I don't know. I just read an article today. They're simply considering how finely split the balance of power is within the chambers of Congress. Basically, every single Democrat needs to be on board, and it looks like that's not the case. So all these things we've been talking about may not see the light of day, or if they do, they may be watered down from what they were proposed to be a month ago. So who knows? But anyway, point is, I guess what you're referring to is the fact that, not the fact, but the proposal that backdoor Roth IRAs would no longer be allowed, or any backdoor Roth, not just IRAs for that matter. But why don't they make the Roth income limits to 400 and 450,000, just like other income limits? Yeah, they should. I don't know. Frankly, my guess is, I don't like to get political. This is just my view of what I think is happening is this getting rid of backdoor Roths is less about closing a problematic loophole, less about raising revenue. If anything, it's not about raising revenue because Roth conversions and stuff actually help bring in current revenue. I think this is more in response to the ire there was as a result of the ProPublica article a handful of months ago about Peter Thiel, the guy who funded a Roth IRA with like $1,000 in PayPal stock decades ago, and now has like $5 billion in it, which good for him. He played the rules right. That didn't sit well with people, of the left-leaning political persuasion. So I think this proposal is really just to placate or to pay lip service to the idea that, yeah, like let's squash the ultra wealthy or even the wealthy, mildly wealthy's ability to get money into a Roth. So yeah, I don't know. That's my thoughts. Great question. Raising the limit, anything's possible. Tax legislation is always subject to change and be tweaked and be completely overhauled. So absolutely anything is possible. It's largely driven by the political power in office at the time. No surprise. I mean, taxes are largely a political tool, for better or worse. So anything is possible. Okay, what else we got? Where'd it just go? Oh, yeah, here it is. I'm sorry, Tony. I know that every retirement is subjective based on the people involved, but is there a minimum number that people should shoot for? Absolutely not. No. So I guess by minimum number, you mean like how much do I need to retire or how much should I have before I retire? Here's a perfect example of why these rules of thumb are nothing but clickbait garbage. So as I mentioned before, there are people out there, I know some personally, who between a combination of healthy Social Security and or pensions and modest expense needs and lifestyle, they have enough pension and Social Security that more than covers from day one of retirement, that more than covers all their anticipated expenses, barring any drastically unforeseen event like huge long-term care event or lawsuit or something out of left field that drains them and their money is not adequately protected. But for the most part, they don't need any additional portfolio assets because they already are bringing in more money than they need for the rest of their lives from pension and Social Security. So in their case, arguably they can get away with zero other assets or close to it. That's one extreme. So for them, their number is zero or close to it. Other folks, you have no pension, you have modest Social Security, and you have, whether it's your choice or not, an expensive lifestyle you want or need to live in retirement. You're going to need a lot of money, whether that means 3 million, 5 million, 10 million, I don't know, but it all depends. So no, there really is no number. Not to plug myself, but on my YouTube channel, I have a video called "How Much Do I Need to Retire?" Check that out. That gives the food for thought. It all starts with mapping out your other sources of income: Social Security, pensions, annuities, rentals if you have them, royalties, other business income. Start with that. Compare that versus the total expenses you want or need to have. To the extent there's a shortfall of income to cover those expenses, that difference is the amount you need to pull out of your portfolio. Then you can get a more reasonable guesstimate of how much portfolio you need based on the withdrawals you need to make. But without doing that exercise, again, it's really rules of thumb are complete garbage when it comes to figuring out the number or a number. But great question, Tony. I don't know if this is a reply to mine or something else. What if you gift to your children and your children in turn gift to their children? Will this avoid generation skipping tax? I don't know. I would hope not. This seems like way too easy of a loophole to take advantage of if that's the case. So my suspicion is no, but I really don't know. Maybe there's some length of time the middle generation would need to wait before passing it on. I don't really know. Good question. Ooh, Roth pro rata. Oh, wow. It's 9 o'clock already. Time flies when you're having fun. Roth pro rata question. I have a pre-tax SEP IRA with $3,000. I want to open a traditional IRA, put in post-tax $6,000, do the backdoor Roth conversion. Goal is to convert all funds this year to a Roth IRA. If I complete the Roth conversion so that all balances are zero in the SEP and traditional by December 31st, do I avoid pro rata? No, you don't, because what happens is when you do pro rata, they will look at your December 31st balances, which in your case will be zero, but they'll make you add back in any conversions you did. So that's where they get you. You will have pro rata. You will have to pay tax on $3,000 in this case if you were to convert $9,000. Good question. Spouse forgot he had, that's just like spouses always forgetting, huh? Spouse forgot he had a 401 from a previous employer equaling up to several $100,000. He is 65 and retired. I still work and earn a significant salary. Suggestions what to do with it. We would take a huge tax hit if he withdraws. I won't retire for at least 10 years. First world problems, I know. Thanks. No, this is specific advice you're looking for. I mean, if you don't need the money, you can let it sit there. He's going to have to start taking it at 72 when required minimum distributions start. So you can't avoid it forever. But if you really don't need it, you're charitably inclined, for example, perhaps you can start donating it. You can roll it to an IRA when he's 70 and a half. He can start donating up to $100,000 per year straight away out of that IRA to qualified charities, and none of that will be taxable distribution. So that's one possibility if you don't want or need the money and you're charitably inclined. Or if you have heirs that are in lower tax brackets than you or whatever, maybe you just don't use this money, take the RMDs and no more than the RMDs when you have to, and just start passing the rest on eventually. Yeah, you can't say, without knowing more about you, but there's a few options, but otherwise, you can't really get rid of it other than donating it, unfortunately. All right, I'll take a few more here. Looks like we're wrapping up anyway. Where'd it go? Should I make an estimated tax payment on an incidental long-term capital gain of $40,000 this year? Otherwise, our income is similar to last year. Is there a penalty if we don't make an estimated payment? Should you? I don't know. Not an easy answer, unfortunately. Is there a penalty? It depends. So, not to plug myself again, but check out, I did videos on my YouTube channel about how to avoid underpayment tax penalties. And one is about making estimated tax payments. Check those out. But to try to sum up quickly, depending what your total tax liability was last year and how much total tax you already paid or will have paid this year, you may not need to make any additional payments for this. You'll just have to pay tax when you file your return, for this gain. But you may be able to avoid the tax penalty depending how much tax you already will have paid for the year. There's something called the safe harbor rule. I dig into that a lot in those videos I reference. So that'll tell you whether or not you should make an estimated payment. If you should and don't, yes, there may be a penalty. It may not be dramatic. I mean, we're talking a few $100s in penalty on 40 grand. It's not going to be thousands of dollars, but still it's a few $100 more than you may want or need to have to pay. So yeah, maybe it is in your interest to make an estimated payment. We're already in the fourth quarter. So I don't know when in the year you sold this position and had this gain, but in theory, if you sold it in first quarter, you should have made that payment in the first quarter. If you're selling it now in the fourth quarter, you can make the payment now in the fourth quarter, which ends January 15th, 2022. But yeah, we need to know more. Check out those other videos I did. That'll give you a lot more insight into this question. All right, looks like one or two more. Mario, if a spouse dies before his or her Roth IRA is 5 years old, does the remaining spouse who inherits the Roth have to wait for the inherited Roth to be 5 years old before making withdrawals? Sort of. Or can remaining spouse combine inherited Roth with his or her existing? Huh. So the reason why I said sort of is if you're a non-spouse, yes, the heir would have to wait out the 5 years before you can withdraw gains without tax. You would always be able to withdraw the deceased's amount of contributions without tax, but gains, you'd still have to wait 5 years before gains can be taken out without tax. That's for non-spouse. For spouse, well, I'm embarrassed I don't know this. Dave Myers, help me out. So with a spouse, can a spouse make a deceased spouse's Roth IRA his or her own, just like you can with a traditional IRA? And if so, does that then look to the 5-year clock status of the surviving spouse's Roth IRA? I want to say, yeah, that sounds like that should be the answer, but for whatever reason, I can't say that with certainty. See if Dave Myers or anyone else knows. I am pretty, I do think you can make a Roth IRA your own if it was your spouse's. Whether or not that then, looks solely to your 5-year clock as opposed to your spouse's, I don't really know. I think so. I don't know. give it a few more minutes, see if someone else says, but this is something to follow up on. Good question. And looks like this is the last one. Next to last one. If someone wanted to use Rule 55, they have a 401k and a Roth 401k. Do you think they can roll over, convert the Roth 401k to their Roth IRA, I guess you mean, and use their traditional 401k for Rule 55 withdrawals? I'm confused on what eventually happens with the Roth 401k portion during decumulation. I think this depends on your plan. So it's quite possible that your plan will require all distributions to be prorated between the various accounts. So like every dollar you take out from your 401k will need to be prorated parts Roth and traditional. I don't know that you can necessarily cherry pick, give me out just Roth assets or convert just Roth assets. Some plans might allow you to cherry pick. I think some do. I always forget and need to look up. I've looked at a bunch of plan documents and I feel like they say different things. So I don't know that it's like a broad law or rule that says all distributions need to be prorated or all distributions need to be just from Roth or just 401k. I do believe plans can structure it however they choose so that it's either prorated or it's just from one or the other. So check with your plan and see if they require you to prorate it, then no, this won't. I don't think this will work. But if they can let you cherry pick and like convert out just the Roth 401k, I don't know if you can hear that. I got my windows open. There's like a chainsaw outside at 9 at night for some reason. If you can't get rid of just your Roth, we'll wrap up soon. They're actually doing street work. That's what that is. It's one of those like concrete saws, late night gas pipe work. If you can convert out your Roth and leave your tax deferred, then sure, you can do withdrawals on just your tax deferred after your Roth is gone. If they make you prorate though, that's going to snag you, and that won't work. And finally, can the entire RMD be used to pay taxes instead of being distributed? Sure. You can withhold as much of your RMD as you want for taxes. If it's coming out of a 401k, they will withhold. I think they withhold at least 20%. Although that may only apply if you're under RMD age. I think I thought all 401ks always have a 20% mandatory withholding, but then I thought that I read somewhere that was only pre-RMD age. But anyway, if this is an IRA, then yes, you have discretion over how much tax you withhold. You can have 100% of the RMD go towards taxes. And finally, Dave Myers looks like chiming in on that inherited Roth IRA from a spouse. Yes, it does look like the surviving spouse can take the deceased spouse Roth IRA, put into his or her own. Then it looks to the surviving spouse's 5-year clock. But like Dave is saying, practically speaking, isn't often an issue. If for no other reason, then I don't know, honestly, how the IRS would ever fact check and prove whether or not this is 5 years old and if you're taking out earnings versus contributions. Because the record keeping you'd have to have from the deceased spouse, have that poured over to you. I just don't know that the integrity of the record keeping is there. Not because you're nefarious, just it seems like it's easier said than done. So in practice, this probably isn't a big issue, even if what Dave and I are saying isn't actually the case. But technically, yes, if you do have to wait for the 5 years to be written out, then you would need to know how much of your deceased spouse's Roth IRA's contributions versus earnings. All right, we'll wrap it there. I don't know if this is loud to you, but with my windows open, it was 80 degrees today here in New Jersey. I have my windows open, and this dumb concrete saw is really loud to me, at least. Hopefully, it's not distracting you all too much. So this is it. Thank you all for joining. I will see you next week. Wish me luck at my first rodeo. And for those of you that'll be in attendance, Mark Troutman and others, looking forward to seeing you. And that's that. Take care. Good night.